If you could only keep one income stream for life, which would you choose? Imagine this. You wake up and the government announces you can only keep one source of passive income for the rest of your life. CPF LIFE, REITs, Singapore Savings Bonds, Dividend ETFs. No switching later. No second chances. Choose now. And just as you're deciding, the Fed announces a wave of rate cuts, flipping the entire income game for Singapore investors in 2025. Who wins in a falling rate world? Who loses? And if I could only keep one, which would I choose? Stay till the end. I'll reveal my choice and why, and it might surprise you. If you find this helpful, like this video, subscribe to Wealth for You, and tap the notification bell so more Singaporeans can learn how to be cash flow rich, not paper rich. Disclaimer. This video is for educational and informational purposes only. It is not financial advice and not a recommendation to buy or sell any investment product. Past performance is not indicative of future results. All investments carry risk, including the possible loss of capital. Always do your own due diligence and consult a licensed financial advisor before making decisions. Chapter 1. The 4 Pillars of Passive Income. When it comes to building passive income in Singapore, picture your financial future like a sturdy table. It stands strong only when all 4 legs are balanced. Each leg represents one pillar of income, each with its own rhythm of stability, yield, and freedom. The first leg is CPF LIFE, your built-in safety net and lifelong payout plan. Every working Singaporean contributes automatically, and from age 65 onward, it pays a guaranteed monthly income for as long as you live. This is your rock-solid foundation. The government backs it, and it keeps paying regardless of market crashes. Your CPF savings earn around 4% in the special and retirement accounts, even up to 6% on the first $60,000 combined balance. So this is the steady heartbeat of your financial plan. The second leg is the Singapore Savings Bond, or SSB. This is your sleep well money, capital protected, government-backed, and redeemable anytime with no penalty. Yields float with the market. In 2022, they spiked above 3.4%, but by late 2025, they've eased to roughly 1.56 to 1.69%. It's not for getting rich. It's for staying calm. SSBs are where you park your emergency cash and still earn something back. Now the third leg, where Singaporeans start to feel like investors. REITs. Think of CapitaLand Integrated Commercial Trust, collecting rent from Raffles City and Plaza Singapura. Ascenda's REIT leasing industrial parks to tech firms. Mapletree Logistics Trust running warehouses across Asia. Fraser's Centrepoint Trust operating Heartland malls from Causeway Point to Tampines 1. These are the quiet landlords paying you quarterly or half-yearly rental checks in the form of dividends. Yields often hover around 5 to 7%, higher than CPF or SSB. But interest rate hikes can squeeze profits, so patience and diversification matter. Finally, the fourth leg. Dividend ETFs and blue-chip stocks, the flexible income builders. Funds like the Lion Phillip S REIT ETF or Amova REIT ETF bundle dozens of REITs into one simple investment. Or you can go straight to Singapore's banking giants, DBS, OCBC, and UOB. Dividend stalwarts that often yield between 4 and 6%, depending on share prices and special payouts. These let your income grow with the economy, compounding as companies raise profits and dividends over time. Each pillar gives you something different: security, yield, or freedom. And real financial strength comes not from choosing one, but from balancing all 4 so that when one leg wobbles, the table still stands firm. Chapter 2. The Safe Harbor. Every investor needs an anchor, a place where waves can crash and nothing moves. For Singaporeans, that anchor is CPF LIFE. Think of it as your personal pension lighthouse. Always on, always steady. From the moment you hit 65, or later if you defer, CPF Life begins sending you a monthly payout that lasts for as long as you live, whether that's 75, 85, or 105. Markets can rise and fall. REITs can rally or crash. But CPF Life keeps paying. Here's why. Your CPF savings in the special, MediSave, and retirement accounts earn a base 4%, and the first $60,000 of your combined balances earn up to 6%. That interest forms the engine that drives those lifelong payouts. It's the one income stream you don't have to monitor, chart, or worry about. You can be sipping kopi at Tiong Bahru or holidaying in Chiang Mai. The payout still lands in your bank account. But like any safe harbor, there are boundaries. Once you set sail into CPF Life, your capital is locked in. You can't withdraw it if markets turn attractive elsewhere. Your family can inherit only what's left after your payouts, not the full balance. And while 4 to 6% sounds strong, inflation over decades can quietly nibble away at your real purchasing power. So CPF Life gives you certainty, not flexibility. Stability, not growth. It's the foundation of retirement security. A solid base you build on top of, not instead of. In the next leg, we'll move from this calm harbor to the bustling world of REITs, where cash flow meets risk, and where the coming Fed rate cuts could change everything. Chapter 3. The Cash Flow Engine. If CPF Life is your safety net, REITs are your cash flow engine, the heartbeat that keeps paying you even when you're not working. These are the quiet landlords of Singapore, collecting rent from the properties we walk through every day. When you shop at Plaza Singapura or grab kopi at Raffles City, you're helping CapitaLand Integrated Commercial Trust generate income. When your online order ships from a warehouse in Tuas or Johor, that's Mapletree Logistics Trust in action. And every time you stroll through Causeway Point, it's Fraser's Centrepoint Trust turning retail foot traffic into dividends. Even our industrial backbone hums under Ascendas REIT, leasing business parks to tech firms and data center tenants. Together, these REITs form the living, breathing ecosystem of Singapore's property economy. And you, the unassuming investor, get a slice of every rent check. Here's the beauty. REITs typically pay 5 to 7% yields, far higher than CPF or SSBs, and they do it without you ever fixing a leaky tap or chasing tenants for rent. They're structured to distribute at least 90% of their income back to investors. That's why they're called trusts. But every engine needs fuel, and for REITs, that fuel is cheap credit. When interest rates rise, their gears grind. Higher borrowing costs mean smaller distributions per unit and weaker unit prices. That's what we saw from 2022 to 2024, a brutal stretch where the Fed's rate hikes hammered REIT valuations across the board. Now, in late 2025, the tide is finally turning. With the Federal Reserve signaling 3 consecutive rate cuts, the wind is shifting back in REIT investors' favor. Lower refinancing costs, improved valuations, and better distribution outlooks are giving long-suffering investors reason to smile again. So, REITs sit in that sweet middle ground. Not as safe as CPF, not as flexible as dividend ETFs, but a beautiful balance of tangible assets and real income. They turn Singapore's skyline, offices, malls, and logistics hubs, into your personal stream of rental cash flow. Next, let's look at what these rate cuts mean for the bigger picture, the entire landscape of income investing in Singapore, and why this new chapter might just be the turning point many have been waiting for. Chapter 4. The Fed rate cut era begins. For the past 3 years, investors everywhere have been holding their breath. Interest rates soared, REIT prices tumbled, bond yields spiked, and everyone asked the same question: when will it end? Now, at last, the winds are shifting. Breaking from Reuters, 24th October 2025. The Federal Reserve is expected to cut interest rates at each of its next 3 meetings after inflation cooled to around 3%, below expectations. In plain English, the Fed thinks it can finally ease off the brakes. And that's huge news for every Singaporean building passive income. Because when the Fed cuts, money starts moving differently. Cheap credit returns, markets breathe again, and yield-hungry investors start hunting for income-producing assets. Let's see what that means, pillar by pillar. For REITs, it's like opening the tap again. Lower refinancing costs mean trusts like CICT, Ascendus, Mapletree Logistics, and Fraser's Centrepoint Trust can refinance loans at cheaper rates, protect their DPU, and maybe even grow again. Investors who stayed patient through the dark times may finally see that recovery spark. For SSBs, the story reverses. As global rates fall, new SSB tranches will likely yield less, maybe closer to average rate of 1.56 to 1.69, making them less attractive for fresh cash. Those who locked in older issues at higher yields will smile quietly. Everyone else might start shifting money elsewhere. For dividend stocks and ETFs, it's a green light. When risk-free yields shrink, investors flow back into equities for better returns. That benefits dividend powerhouses like DBS, OCBC, and UOB, as well as diversified income ETFs such as Lion Phillip S REIT ETF and Amova REIT ETF. Stock valuations may rise, and dividend yields could hold steady or even improve as earnings strengthen. For CPF Life, the world could spin upside down and it would still stand firm. Its formula is tied to government-set interest rates, not market rates, so nothing changes in the short term. It remains your steady anchor while everything else adjusts. So, this new era of falling rates doesn't mean easy money. It means new opportunity. For the first time in years, cash flow investors can play offense again, adding selectively to REITs, rebalancing from bonds, and positioning for the next wave of income growth. The cycle is turning. The question now is, will you move with it or miss it? Next, let's slow things down and look at the sleep well side of the equation, the Singapore Savings Bond, where capital protection meets calm, even if the returns don't make headlines. Chapter 5. The Sleep Well Option. Every portfolio needs a place to rest. Not every dollar must sprint for returns. Some are meant to stand guard. That's where the Singapore Savings Bond, or SSB, quietly does its job. Think of the SSB as your copy break investment, steady, familiar, and safe. It doesn't make headlines, but it helps you sleep soundly at night. Fully backed by the Singapore government, the SSB carries virtually zero credit risk. Your capital never disappears, and you can redeem it any month you like. Just pay a small $2 transaction fee. When you cash out, you get back your full principal plus any interest earned, usually within 2 business days of the following month. That flexibility is why many Singaporeans use SSBs as an emergency cash drawer. If markets crash or your REITs tumble, this is the cushion that stops you from panic selling. Yields move with the broader bond market. When inflation spiked in 2022, new 10-year SSBs offered around 3.4% on average. Today, as the Fed begins cutting rates, new issues hover closer to an average rate of 1.56 to 1.69%. Still respectable, but trending lower. And yes, while some high-yield bank accounts may pay above 3% if you jump through spending or salary credit hoops, the SSB asks nothing of you. No conditions, no monthly tasks, just quiet, predictable interest. So the SSB's role is not to make you rich, but to keep you calm. It's the ballast in your financial ship, the weight that steadies everything else. Because when your foundation feels safe, you can afford to let the rest of your money work harder. Next, we'll look at the engine that does work harder. Dividend ETFs and blue chip stocks, where flexibility meets freedom and income grows with the Singapore economy itself. Chapter 6. The Flexible Income. If CPF Life is your safety net and SSB your cushion, then dividend stocks and ETFs are the engine that powers your financial freedom. This is where your money finally gets to work, not just sitting still, but growing and paying you at the same time. Think about the companies that shape Singapore's heartbeat every day. DBS, OCBC, and UOB, the big three banks that fund our homes, our businesses, and the nation's growth. In recent years, their dividend yields have hovered around 4 to 6%, sometimes higher when special dividends roll in after record profits. These banks aren't just paying you income, they're paying you for participating in Singapore's prosperity itself. Then there are dividend-focused ETFs, ready-made baskets of income assets that remove the stress of picking winners. Funds like the Lion Phillip S REIT ETF and the Amova REIT ETF give you exposure to dozens of REITs at once, from Ascendas REIT to Mapletree Logistics Trust and Fraser's Centrepoint Trust, spreading risk across sectors and countries. Instead of worrying about one REIT's refinancing, you're collecting steady payouts from an entire portfolio of properties and businesses. The beauty of dividend investing is flexibility. You can DCA monthly, dollar cost average in small amounts, and let compounding quietly build your snowball. You can reinvest dividends to accelerate growth, or withdraw them for living expenses when you reach financial independence. You control the flow. But flexibility also demands discipline. Markets fluctuate, yields change, and dividends can be cut during downturns. The investors who succeed are those who stay invested. Through noise, through panic, through this time is different headlines. Because over time, dividends reward consistency. In a world where interest rates fall and inflation creeps, dividend investing bridges both worlds, income today and growth tomorrow. It's the strategy for those who want more than just safety. They want freedom income that grows as Singapore grows. Next, we'll bring it all together in the final chapter, where I reveal which one I'd keep forever, if I could only choose one. Chapter 7. If I could only keep one. After all that, CPF Life, SSB, REITs, Dividend ETFs. If I could only keep one source of passive income for the rest of my life. Here's my honest answer. I'd keep dividend stocks and ETFs, the freedom engine. Now, this is a personal choice, not a one-size-fits-all rule. A conservative investor who values guaranteed stability might pick CPF Life or SSB. A retiree who wants predictable lifelong income might lean on CPF Life. But for someone building long-term wealth and seeking both growth and flexibility, dividend investing ticks the right boxes. CPF Life gives certainty. It will pay you for life. REITs give yield, steady, tangible income from properties like CICT, Ascendas REIT, or Mapletree Logistics Trust. SSBs give safety, a calm harbor for your cash. But dividends give you something rarer, control. The ability to decide what to own, when to buy or sell, and when to spend or reinvest. When companies like DBS, OCBC, and UOB grow profits, they often share the rewards through higher dividends. When REIT-focused ETFs such as Lion Phillip S REIT ETF or Amova REIT ETF expand their portfolios, your income participation grows with them. In that sense, dividend investing is not just collecting payouts. It's owning a slice of Singapore's economy as it expands over time. Of course, dividends fluctuate, and markets will test your patience. But unlike fixed products, dividend portfolios evolve with the world, a built-in hedge against inflation and a pathway to compounding freedom. That's why, if I could only keep one, I'd keep the one that grows with me. The one that keeps paying even when I stop working. Final thoughts. Now it's your turn. If you could only keep one, CPF Life, REITs, SSB, or dividends, which would you choose and why? Would you go for certainty with CPF Life, safety with SSBs, high yield with REITs, or freedom and growth with dividend stocks and ETFs? Drop your answer below. I'll be featuring some of your best comments in the next episode, so don't hold back. Because in the end, financial independence isn't about being paper rich, it's about being cash flow rich, having income that grows, protects, and gives you the freedom to live life on your own terms. If you found this video helpful, please like it so more Singaporeans can see it. Subscribe to Wealth for You and press the notification bell to stay updated on CPF, REITs, and dividend strategies that build true freedom income. And as always, keep your cash flow growing and your kopi warm.